Welcome everyone to today's webinar, Private Schools and How to Get Ready for Your Next Audit. So before we get started and I hand it off to our presenters, I do want to go over a few housekeeping items. So just so you know, you can maximize or minimize the webinar pane during the presentation by using the red and orange arrow buttons. And during the webinar, we definitely encourage you to ask questions. Also in the webinar pane, you can see a questions box where you can type in your question and click submit, and our presenters will answer those throughout the presentation and at the end as time allows. And I also want to make sure everyone has good audio, so if you're using a telephone, make sure you select the phone call audio option, and if you're listening through your computer, please select the computer audio option. Now, if you're joining us today for CPE, just a few reminders. You need to make sure you're using a personal computer, no smartphones, and you're logged in with your own information and unique URL. You also need to be logged into our online software for at least 50 consecutive minutes and actively respond to at least 75% of the polling questions. So today we're at 4, so make sure you answer at least 3. And then we also ask that you complete the evaluation survey at the end of the webinar. So then we're going to go into the polling questions, and today we're going to review best practices for communication strategies throughout the year, discuss the most common internal control findings, and adjustment journal entries found during the audit process. And we're also going to recognize how today's best schools are avoiding common audit pitfalls. I do want to introduce our presenters. Today we have Addie, who's joining us from PAYSBOA, and she's been with PAYSBOA since July 2016, and before her work there, she spent over 20 years in independent schools in a variety of senior leadership roles. We also have Matt Gard, who joined Armenio back in September 2006, and he has worked on over 200 schools since then. He works extensively with clients in the nonprofit financial services and manufacturing and distribution industries. And then we also have Dean, who after spending 12 years as an auditor, he's transitioned to be our chief relationship builder for the firm, and he helps numerous private, public, and nonprofit companies address their tax audit and outsourcing needs. And since then, he's worked with schools for about 20 years. And I'll pass it off.
Awesome. Thank you so much for having us today. We're definitely excited. If you were at NBOA, we were able to do this presentation there and got some really good feedback, and we're going to share it with the folks of PAYSBOA today. Really, before you get down and into the nitty-gritty of the audit, right, Matt? There's some main points that are going to come up often when it comes to preparing for your audit, and they're going to be communicate often, being transparent, and really working with your auditors, whether it's on the prepared by client list or other items. Nobody likes surprises, right, Matt?
No, absolutely. If you have, the main takeaway from this, and we're going to get into some more complicated and more, nitty gritty accounting stuff, but the main takeaway, if you want to, improve the audit process is on this slide, right? When I think about all the audits, when I think back on ones that, just did not go well, if we had done some of these items on this slide, it probably would have been a lot better, right? First, communicate often. Schools we tend to see are, they're very good at accounting for the day-to-day transactions, right? They know how their school operates. They know how to account for that. When they run into some issues is when some more complex transactions come up, something they might not have seen before.
Maybe something you only account for one every 5 years, one every like that, 10 right? years. And of course, do we expect you to get that completely right if you only account for it every 5 years? Those are the challenges, right?
Absolutely. And that's why it's important to communicate often with your auditors throughout the year. When those things come up, communicate in real time, right? Get their feedback, kind of flows into the next one. Be transparent. If something comes up and you don't know what to do about it, don't just file it away in a drawer and hope it doesn't come up. Talk through it with your auditors, because they likely will find it, right? If you don't. And it's very important to make sure that everyone's on the same page so there are no surprises.
And the interesting piece is that, you, like I said earlier, you don't want surprises. Well, auditors don't like surprises either. And it's always very interesting when we go out the first couple of days of field work or during interim or whenever, and you're like, well, what's this? Oh, we're doing this, or oh, we're doing that. Oh, we were named in a charitable remainder trust, or oh, we were named in a will or an estate or something like that. To the extent that it's a partnership is really where you want to be.
Yeah, and then just the last one on the PBC list, I think this one's really important as well. Have a call with your auditors in advance to go through it. I find a lot of times we show up on site and, the client says, well, I didn't really understand that question, so I just, skipped it for now. Or you really didn't need that, did you? Well, if it's on the list, it's likely that we do need it. So, make sure you're working through that list with your auditors. And to the extent that there's time available, if you can have that completed, a week or two in advance to the auditors showing up in field work so that they can review it and make sure everyone's on the same page before we get started. That's, going to make sure we're off to a great starting point when we actually start the audits.
Yeah, and even more than that, to the extent that, we don't really want you creating schedules just for the audit. Man, that sounds like a lot of work. If we can leverage the work that you already do to run your school, from a financial and operating perspective, that's what we want to do. So maybe we have a name for a schedule on there that, we always call it, but if you have time to go through this list with your auditors, you could say, hey, well, if I understand the why of why you need that report, and maybe you can understand that, and you could say, well, I don't have a report like that, but I have this. And that could alleviate the need to create a new schedule just for the audit, because that's the last thing we want to do.
Hey guys,
Yeah.
I'm not a CPA, nor am I an accountant, and some of our business officers are not those things either. So can you tell me what PBC stands for?
I love it.
Get the gist of it, but I don't know what that acronym stands for.
Yeah, it's an acronym. I think it's been in the public accounting space forever, but prepared by client, provided by client, kind of same thing. So that schedule request you get with the list of all the items you're going to need for the audit, you may hear it be called the PBC list, and that's really what it means. It's prepared, provided by the client.
So basically, it's all
I know
the things
what it is.
Right? Yeah, because you had to. People have to do it. They have to prepare it, but it's the things that we need. It's basically what we're going to audit, right? The schedules we're going to request when we do the audit.
And I think it's such a good point to talk about the schedules that you're requesting and how you can use some of the reports that you already have generated, because there's so much stuff to gather for the audit prep and the work days when the auditors come out. So it would be nice to have that conversation in advance so that maybe you can not have to prepare a special report just for the audit, but provide the same information.
Yeah. Nope, that's exactly right. We want to be effective, right, and efficient. So to the extent that we can leverage what you already do, that's the goal. We don't want to make you recreate any wheels or do anything new. Okay, so the next slide is, again, if you have a good relationship, if you have a good partnership, if you're transparent, then you can also use your auditor to help you through this process. Again, before we get to the nitty-gritty, what we like to say is, we can work with you to validate the things that you do really well, right? Because we know that there's lots of schools that do things really well, and your board should know that. Your finance committee, your audit committee should know that. So validation, and then the other piece is being that change agent, helping you do that, helping you validate that by, if hopefully you guys are working with someone who knows schools, who can say, okay, maybe you're the 3-person business office, and these are the things that you guys do really well, and maybe you've been there for 2 or 3 years, and you have inherited people that have been there for 15 to 20. And we know in that case, change is hard. And so sometimes you know what you want to do, but you need somebody else to say it, because if you say it, it kind of falls on deaf ears. If the auditor says it, oh my goodness, everybody is like, okay, yeah, we need to do that. So work as a partnership with your auditors, and they can help as a change agent or validate what you're doing. Matt, one of the key things that we find a lot is maybe it's not the 3-person business office, maybe it's the 1-person business office, right, Aggie? And you've told us that you have numerous schools that have 1 person in the business office who has to, have really broad shoulders and do everything. And so when that happens, that's when recommendations shouldn't really be about, hey, hire another person. Maybe they should, and maybe you are overloaded. You can have your auditors recommend that, but maybe it's just getting other people involved, right, Matt?
Absolutely. And that's where, this first point, where best practice recommendations, if your auditor is working with, many different schools that they may have that one person business office. Well, how do they, segregate duties, and how do they do internal controls? And like Dean said, maybe the solution isn't that the school can't hire an additional body at this point, but they can get someone else involved, someone from, finance committee, board level, providing additional oversight that can, lead to some better controls when you're in that types of situations.
No, that's right as well. And then again, we've talked about complicated transactions, get advice and doing all of those things throughout the year. That is clutch. I tell this example all the time, but I once worked on a school that had about a $4.5 million balance sheet, and almost done with the financial statements. And that year, our summer intern happened to be an alumni of that school, and she came to me and she said, "Hey, Dean, isn't it so great? I heard you're doing the audit for my school." And I'm like, "Yeah, I am, as we speak." And then she says, "Isn't it great they got that big gift?" And I was like, big gift. And so I went back to my desk, being the good senior auditor that I was, and I said, "Wow, their balance sheet's only $4 million, but big gift is a relative term, right? To a college intern, or depending on who you're talking to a major donor." And so I went back to her and I said, "Big gift, like how big was that?" And she goes, "I don't know, like $5 or $10 million." And I was like, "Oh my gosh, okay." So I gave that business manager a call, and she was a one-person business office. And I said, "Hey, I heard that you guys might have got like a big gift, like a $5 or $10 million, but your whole balance sheet is only $4 million. And she goes, "Oh yeah, Dean, we were named in the will of a person." And I go, "Well, that's good. That's great." I go, but you can't record wills until the person dies." And she goes, "Yeah, he died." And I'm like, "Uh-oh. Okay, great. Well, who else is named in the will?" She said. I go, "Are you splitting it with the kids or what?" No one. Our school is the 100% beneficiary of the will and estate. And I'm like, "Well, since he passed, we need to book this." So to make a long story short, that turned out to be a $16 million estate, 3 times larger than the balance sheet of that school. And it was just because it was a complicated, we didn't know what to do. And so they didn't. That's exactly what we're talking about.
Definitely.
So again, and then the last piece, Matt, let's talk about some technology real quick.
Yeah, I mean, most schools I go out to, there's some sort of, technology frustration. They're not getting the reports they need. Maybe they don't have the right systems in place. This is something you should be talking to your auditors about. They see lots of different types of software technologies, and can give some best practice recommendations on what other schools are doing. And I would say the other thing, not just what technologies are out there or what's frustrating about our current technology, is I also have lots of schools who are frustrated with all the manual processes they're doing, and as
workarounds.
Exactly. And as software continues to get better and better, there's lots of ways schools can automate processes. I was just at a school a few weeks ago, and they were talking about all the different, we're just talking through their processes and their accounting controls, and we've come to find out that there's a number of ways that they could implement different things within their current software already that would save countless hours each week. So this is, again, something that you should be talking to your auditors about, as to how can we better use the software we currently have to automate processes, transactions, etc.
Great. Okay, our very first polling question.
Awesome, we'll get that launched. So the question is, so how familiar are you with the updated reporting requirements for nonprofits? So do you know that the changes are coming, but maybe you're unfamiliar, or you've heard about the specifics, but maybe you don't know or understand them fully, or that you're somewhat knowledgeable with the new requirements, or the last one that you are good to go and you're ready to implement? So go ahead and get your vote in.
And again, this is question 1 of 4. You need to answer 3 of them. And with regards to this one, I think if you sat in on the last webinar, then you'll be feeling a little a little ahead of the curve, I hope, with regards to this one. But we'll be talking a little bit about, again, about some of the changes coming for nonprofit towards the end of this webinar, right, Matt?
Well, and I think, Aggie asked us to really hammer this home because, it's coming up and we'll see what the results of the poll look like. But I imagine there's, going to be a number of schools that, aren't quite ready for this. And, we're months away from fully implementing this. So, as we go through the process and talk about common audit issues and things we see, anything that will change in relation to this new standard, we're going to start talking about, as it comes up. And then kind of to Dean's point, as we wrap up, we'll make sure we really hit home what the key takeaways for that new standard are.
Awesome. So it looks like it's split between knowing that the changes are coming and maybe unsure about the specifics. And then some of you are knowledgeable of the new requirements. And about 22% are ready to implement.
Awesome. That's 22%. I'm really happy to see that. That's great.
Yeah, but to your point, there's 80%.
Last time.
Yeah, that's right, Aggie.
But there's still
Good
80%
job.
that need to know some more of the specifics. So we'll make sure we hit on all of those as we move forward.
Awesome. Okay, let's start. What we thought we would do now is, jump through different areas of the audit and talk about common errors that we find. We want to give you the answers as much as possible. So we'll start jumping through. If you guys have any questions throughout, please feel free. But the very first one, this one's pretty basic, cash and cash equivalents. And if all I could say is the number one thing here is just completeness, right? Like in the story I just talked about, everybody can audit a cash account or reconcile a checking account for what they can see. The hardest one is the one that's not on the general ledger. So this always comes down to the PTG group, the Parents Association, things of that nature that are 100% checking accounts or investment accounts or savings accounts that go to the benefit of the school that are not recorded on the GL, right, Matt?
Yeah, absolutely. And those, if those organizations are, part of the school and the structure of the school, they should be rolled up into the school's financial statements. Similar to, the next item on here is, if you have agency funds to parent or student accounts, whether those should be, recognized as a liability versus, recognized into the P&L. Depends on the structure. Again, if they're separate entities and separate 501c3s, or if they're rolled up into the school. The last couple of things on here are kind of minor, just reclass type things, but depending on your cash policy, you may have some cash sitting in investment accounts that really should be presented as cash on the financial statements. So making sure any of those amounts are accounted for and properly reclassed. And then just the last best practice tip, it goes back to what Dean said, and something we'll talk about, on a number of these different areas, is the completeness, right? We can audit stuff that's there. If it's not there, it's hard for us to know what it is. So making sure you have a complete listing of all the accounts, bank name, type of account, and account number. And how this helps you and your auditors is you have that list. Most of the time your auditors are going to confirm your cash balances, right? If you already have this listing with all this information on it, send that off to your auditors. Most banks will electronically confirm cash these days. They, put it through the system and you're done with that process. So, important to make sure you have that complete listing.
Awesome. Okay. The next section is investments. And, there's lots of, we're starting to see more and more, I think the word to use is exotic or alternative investments these days. One of our schools hit the newspapers last year, hit the PR wire, and that was St. Francis High School of Mountain View. They were in the Wall Street Journal last year. They had a $15,000 seed investment in a small company that you probably don't use. I don't really use it on my phone. I'll say that too much, but the younger generations, boy, they love it. And that company was called Snapchat. And they turned that $15,000, and this was public, hit the Wall Street Journal last year, into a $40 million realization when Snapchat went public. How that school is ever going to get a tuition increase, again,
Good luck.
I don't know. But there was some significant accounting for that type of investment all the way through. You don't just go from $15,000 to 40 million and recognize a $39,995,000 gain. But so, to that extent, but we see other things. We see real estate investments. We see other alternative investments. We see lots of level 3 investments. And so those are the types of things that when it comes down to it that we want to be looking out for, right?
Yeah, I think in investments, it all comes down to valuation, right? And how we value these particularly more difficult or alternative type investments. We can all understand, if you own some shares in a S&P 500 mutual fund, it's easy to record what that value is, right?
On any day.
On any given day, right? Versus, to Dean's point, investment in at the time when they made the investment, a small, non-public company just getting its, early financing, all the way to becoming a public company. And how do you value that each and every year? So it's really important to discuss that with your auditors. Look at what information is available to value those types of things, whether it be something like that or real estate. I will say, just working in the school world, I'm starting to see more and more, not necessarily, making an investment in a non-public company, but where donors are giving schools stock shares in non-public companies as a donation. And when they're giving to the school they hold the shares in the investment, how do you value that, right? Yeah. It's non-public. Again, this is when the types of things come up, make sure you're discussing that with your auditors to make sure we get the right valuation on the books. I had a school that, we got, several thousand shares in this non-public company. We have no idea what the value is, so we didn't record anything. We just, filed it away in the cabinet, right? That's not the right answer. So again, just anytime any of these things come up, make sure you're discussing.
Right, and it's really the let's face it, the vast majority aren't going to be the ones that turn into $40 million. The vast majority could be, you need to mark that valuation down because maybe that company's not doing so hot. But it's what we want to know is what are you doing to get comfortable with the value that you have recorded on the books? That's really where we want to get to. How are you doing any research? Are you now talking to the people who gave you that stock who might be involved in that company? Or are you doing anything to get comfortable? Because at the end of the day, these are your financial statements. And we just want to make sure that you guys have the controls and the policies in place to do all that. I will say that some organizations do that investment roll forward once a year. That's a challenge. That's a lot of activity. I'd say a best practice here is if you could do that at least quarterly, but best practice is once a month of rolling forward your investments. It makes it really easy.
Just easier if you're doing it on a monthly basis as you get your statement rolling forward the activity, because your auditors are going to need to see what that roll forward of your investment activity looks like from beginning of the year to the end of the year. And obviously want to make things more simple for our school clients, and doing that on a monthly basis really helps with that.
Great. Matt, real quick, let's talk about planned giving agreements. I feel like those always pop up on your schools. Maybe we can talk about that real quick.
And I don't think we need to go into too much detail, but I think
any words they should look for, any key words? Yeah,
absolutely. I think anytime you see will, trust, any planned giving type of agreement that comes in during the year, I would talk with your auditors about it. To Dean told a story earlier about the will that, it was conditional at that point in time, you don't record it, but then when it became irrevocable, that's when you record it. It's just important to make sure your auditors are aware of that, and knowing that if there's a big gift coming, it might not be recorded now, but maybe it should be disclosed in the financial statements. If it's that large of a conditional type gift or planned giving agreement, should it be disclosed in the financials? And I think the biggest takeaway is anytime you hear that language, right? Trust, we've been named in a trust, a will, whatever other planned giving, charitable annuity, whatever it might be, just talk with your auditors, make sure you're on the same page so that no surprises come.
Get the documents behind it and, pass them around for sure.
Hey guys.
Oh, yes.
Can you talk a little bit about Bitcoin and other cryptocurrency? Because some of our schools are seeing or getting questions about that.
Yeah, and so are we. We're trying to learn on the fly as well. But yeah, I mean, I've been getting questions from schools on, parents wanting to pay tuition in Bitcoin. And, kind of our standpoint was it's probably not a good path you want to be going on for tuition payments. But, I think it's going to come up, and as more and more information on this comes out, I know we're exploring a whole practice area in regards to cryptocurrency, and we're really trying to figure out best practices for this.
Yeah, so we do have a blockchain practice here at Armanino, and right now one of the biggest applications of blockchain is crypto, but it is highly volatile. Right. And I mean, a lot of schools have a policy of when they get specific investments, like when someone donates a specific, even if it's a different, say it's just a specific company stock, most schools have the policy of liquidating that investment and then putting it to their normal portfolio, not keeping it in that specific investment. I would assume that crypto and other type of, ulterior motives of payment would kind of fall under the same policy. Now, if you want to ride that wave, then now that falls into your investment policy.
Right.
But I think we are going to be seeing more and more of that, especially since I just saw that JP Morgan is going to be coming out with their own token. So I feel like we're going to see more of it. And we'll probably be putting out some best practices around that. Thank you, Aggie.
Great.
Great question. Okay, polling question number 2.
Awesome. So which section of the financial statement gives you the most trouble during the audit? Is it net assets, contributions, revenue, and receivables, investments, or is it something else? Go ahead and let us know.
All right, we're at about 60% voted. We definitely want to give you guys a little bit more time. This is question 2 of 4, and like we said, we need to answer 3 of them. So we need just a couple more people to get your answers in so you can qualify for your credits, and we'll go from there.
So we have about 80% in, so we'll go ahead and close the poll.
So net assets, about 56%. That's what I would have guessed when I first saw the question. That seems to be the area that, and we'll be getting to that here soon, but that seems to be the area that have the most questions. It's one of the more complicated ones, nonprofit accounting and how net assets are treated, restrictions versus designations, all that good stuff that we'll be talking about. So yeah, I'm not surprised that's the one that was chosen as most tricky.
Especially when you move from for-profit to nonprofit.
Right.
So, all right, tuitions receivable. Matt, this one's pretty easy. We don't really have too many adjustments here, but if we do, what are they?
If we do have adjustments here, it's collectability, right? When you walk into the school and they've had a receivable on the books for a number of years, the student is long gone from the school, the family's long gone. What are you really going to be able to collect that?
Yeah.
And it's just, periodically reviewing that list, making sure it's collectability is considered, if there's anything that should be written off, reserved for, and if there's any valuation issues there. Best practice, like it just says on here, is make sure you have a schedule that agrees to the GL. A lot of times that's their best practice, right? Making sure we have a detailed schedule for our accounts of what is that outstanding receivable looks like.
And no one's saying you have to write it off. You could, if you feel like, hey, maybe they have younger siblings or something like that they're going to try to get into the school, you can keep that on your books, but you probably want to allow for it. Okay, contributions receivable, another area where we do see a lot of journal entries, right? When we talk about the audit's gone wrong or the audit train wrecks, unfortunately, a lot of the adjusting journal entries will come in this area, particularly around capital campaigns or challenge grants or things of that nature. What are the major items that we want to be looking for here, Matt?
Yeah, I mean, I think this is one of the more complicated areas, just the fact that it's, it's definitely different than what we consider, just how things work, right? These are non-reciprocal transactions. Donors are pledging amounts. They're not getting a service or good in return, right? And the way the GAAP accounting rules work is you record that revenue when that promise to give is made. That even
Not when it's paid,
the cash may come in years afterwards. So it's just kind of a unusual feeling to record that or understand how that works. So that's, we see a lot of, issues here. The biggest things I think are, is it a valid pledge? Should it be recorded? Are there conditions attached to it? This is where, again, when Dean mentioned, capital campaign, this is where we see a lot of the issues in this area, and making sure any language in those agreements are properly recorded with what the donor's intent was. And there's obviously accounting rules as to, you can only book the unconditional pledge. If there's a condition, a matching condition that might not be met, that's the big one that we probably see in schools and nonprofits in general. When do we record that pledge, right? And anytime there's some more complicated language versus I am pledging you this amount, those are types of things when you want to spend some time making sure you really understand the donor's intent and the accounting behind it.
Yeah, donor intent, and then sometimes it's not even intent, but it's implied intent. We do have schools that, to their new 8th grade families that are coming into the high school, solicit an annual fund pledge. And they allow for that family to pay that annual fund pledge in 4 years, which is kind of an oxymoron, right? It's supposed to be an annual fund, and you just said we're going to pay it over 4 years. With that comes an implied time restriction. I don't know if anybody's doing that, but essentially the next 3 years, because it's not going to be, payment isn't due for the following 3 years, that part needs to be restricted as a time restriction. So something that you want to be looking for there, different things like that. I will also say is that, with campaigns, we do see some language, right, where say you're building and just to make it easy, $10 million, we're raising $10 million for a performing arts facility, of which $9 million is going to go to the building, $1 million or 10% of the funds raised is going to go to an endowment fund, where those proceeds from the endowment fund will go towards maintenance. Well, again, the big question here is what 10%? If you talk to everybody building the building, they're going to say the last 10%. But when you read the form, it says 10%. So for every $1,000 is $100 going to this endowment fund. Those are the types of things that we want to be looking out for here. When it comes to conditional pledges, is it waterfall earnouts or a challenge grant? Is it a waterfall or is it cliff, right? Do you get to earn it every $1 million, or do you only get to earn it after you raise $5 million? What are the things there? This is where you just want to be lockstep with your auditor, your investment director. I mean, not your investment, your development director, and your head of school. And I would say that is a best practice here, is that you as the business officer, at least for the audit, but on a best case scenario on a quarterly basis, you should have a meeting with your development director and your head of school to make sure that everything is complete and the valuation is recorded correctly, because we know that they're out doing a lot of the fundraising. The head of school and the development director are out there doing all these things, and we know that they don't always tell you about it as the business officer. So let's go out and get ahead of it and create that best practice.
Yeah, absolutely. It's important to make sure you're aware of anything that's out there that development knows about that you might not know about as a business manager. But then also, a couple of these things talk about making sure allowance is recorded, right? And if there's any collectability issues with the pledges, oftentimes advancement is going to be the ones who are on the forefront of that and can communicate what that correspondence looks like to determine are there pledges that should be written off, reserved for, is they're unlikely they're going to be collected. It's something that you should be looking at prior to the audit.
Yeah, Matt and I definitely worked on a school, unfortunately, where students were going there paying tuition. It was like a $300,000 gift for the locker room, and right as the kids graduated, that thing didn't get paid and they had to take all the plaques down. And so that's kind of where this best practice was born out of, is that everybody needs to be on the same page here. Okay, Fixed assets. What are we looking for here, Matt?
Yeah, so I mean, going back to what we talked about at the beginning, if you're going to know how to record, your purchases of computers, desks, and all that good stuff. Where we find audit issues is, when you have a big construction project going on. That's when things get a little bit more complicated. So with construction, common errors that I see is one, not recording all the payables related to that construction at year end, right? If you're doing construction during, when school gets out and through the summer months, you're supposed to record your construction and progress and a related payable for any amounts incurred, prior to your balance sheet date. Well, oftentimes that invoice might not come in for, a month, 2 months, whatever it may be. And so sometimes that last accrual or that last payable for the construction related project might go unrecorded, when we come in to do the audit. And then the other piece of that always gets missed, I think, is retention. Right?
Yep. What is retention?
So retention is basically that last, on a construction project, that last 10% that gets held back to make sure that, all the final checklist items get completed, that the project's done, and then, it gets paid. So there's the 10% that gets held back on all your progress bills really should be recorded for whatever's been incurred prior to your balance sheet date. So you should have record that retention as a payable as of June 30th. That's one that gets missed a lot.
Great. Is there any other things in fixed assets that kind of get tricky? Or
the other construction thing, and it goes along with net assets, is when you're doing a construction project, you're raising a bunch of donor money from it. It's all restricted for that project. When you're remitting cash for the project, well, when does those restrictions actually get released? And what GAAP would say is that those restrictions are not met until the building is placed into service. So,
which is kind of illogical, right? Because I would figure if someone is giving me money to build the building, then as I spend those dollars to build the building, I should be able to release it. But that's not what's going on here.
Right, because basically the donor's saying this money is for a new building, and until that building is built and done,
it's on you.
Exactly.
It's on you, the school.
Restricted. So that's when we get questions about that all the time, in making sure you're not releasing that until your building is done and placed into service.
Yeah, that's probably one of our top 10. That's on our list of top 10 journal entries.
Yes,
for sure. Okay. AP and accruals. This one's pretty straightforward, but we definitely have some adjustments here at some point in time. So.
Yeah, the couple things. I mean, you would think best practice is just making sure you have a detail of what your AP is as of June 30th.
And it agrees.
And it agrees to your general ledger, but we do come into some like you need what? You need a list of all those payables? Well, making sure you have that in place. As far as the actual accounting and where there's some where we see audit entries or adjustments is mostly faculty payroll, right?
Mm-hmm.
Your faculty have done their service for the year as of June 30th, but they may be getting paid out over the summer months.
Mm-hmm.
Have you accrued that payroll? That's one that we see a lot. And then lastly, just vacation or PTO type of accruals, making sure that you've accrued for what has been earned but not paid out as of that date, and that you have a schedule that ties and agrees back to that.
Awesome. Okay. Debt. Here we go with debt. Well, this one seems like it's pretty straightforward. You have a balance that you owe and you record it. There are some nuances here. I'd say that, especially with debt covenants, we want to be looking at those pretty closely. You want to manage that, especially with regards to pro forma. Here's one where upcoming changes are something that you want to get out ahead with your banker on. We have leasing changes coming that are going to put the asset that is being leased on the balance sheet, as well as the obligation as well, and what could that do to your ratios? We have liquidity standards that are coming. What would that do? So you definitely want to be out in front of it and know what any kind of pro forma changes to your financial statements would do to your covenants, right, Matt?
Yeah, absolutely. Thinking ahead to what some of these changes might do to that, but just in general, when I come to do a school audit, this is pretty common sometimes that school hasn't even really been looking at their covenants throughout the year. The bank hasn't bugged us about it. I think we're doing fine. And then you come in and the auditors are going to look at that, because what we want to make sure you're in compliance, because if we sign off on the audit report and we don't say that you're not in compliance and you're not in compliance, that's a big issue. So it's something we're going to pay particularly close attention to. And I had a school this past year that, wasn't looking at it. We came in to do the audit. We looked at it and said, guys, you're not in compliance with this covenant. Well, they hadn't been talking to their bank throughout the year. So before we could issue a report, they had to go through that process, making sure they could get a covenant waiver. And, we were expecting to issue at a certain point in time, and the bank's going to take their time and to look at it and look at projections and make sure they're comfortable. That could take several months. So, we pushed our timeline out several months just because they weren't looking at that.
And for a lot of agreements, that pushes them into default.
Absolutely.
Right. So now they got to get out of default and make sure that it's all happening. One thing on debt, and it relates to the fixed assets, is just capitalized interest, right? I know that's not on here, but you want to talk about that really quickly?
Yeah, I guess should talk about on the fixed asset and the construction side. But if you are, taking out debt to build your project, you should be capitalizing that interest into the project, right? It's a piece of it's a construction cost, right? You needed to acquire this debt in order to do the project. Any interest that you're paying on the debt should get capitalized into the project.
Great.
The last thing on here, I would just say, if there's any changes, obviously new agreements, you'll be surprised how many times we put it on the PBC list, the scheduled request list. Need any new debt agreements, nothing gets filled in there. We're halfway through the audit and it somehow comes up that, actually we restructured this debt, or this is a change. This is stuff your auditor should be aware of early on in the process. Again, making sure that they're aware of any changes, any new items. The other thing is I've also seen, where a school might have a line of credit and there's no balance on it, right? So we can't see it. It's not on the general ledger. We still need to know that you have that line of credit is available. And
that's going to be important in your liquidity disclosure in the next couple months, right? Because to know that you have those resources available, again, is another asset. I mean, I know we talk about recording a line of credit as a liability, but in the big picture, it's an asset to you and your school and your liquidity.
It's a use of cash that you have to be able to, meet your expenditures over the next year. And so, when we talk a little bit more about what your liquidity footnote looks like, this is a piece of it.
Matt, one of the things that we see at maybe some of our smaller schools that are just getting off the ground or stabilizing their foundation is we do see loans from board members to kind of get them going. And then sometimes after a period of time, we see debt forgiveness. Is there anything that we should talk about there as an auditor that we want to see? What would we want to confirm? What would make us comfortable in that situation?
Just need to, make sure we see all the documentation related to it from the party that's, forgiving the debt, making sure we're comfortable that
it's really forgiven.
Exactly, but there's no expectation that, somewhere down the line it does get paid back.
Sure.
Really getting comfortable with the terms of that forgiveness.
And would that be email, or would you want to see some kind of formal agreement at that point?
I think for something like that, you want a formal agreement, right? You want to be comfortable that it's not going to come back to bite you later on.
Great. Just be ultra transparent and clear.
Yep.
Sounds like.
Can I ask you to touch on one thing?
Please.
So you mentioned the donor who is helping a school get off the ground. We have some schools that have been, running in the red, who have donors who have bailed them out. And, some of this is in the form of loans and some of it is in the form of a donation. And how important is it to do some paperwork around those angel donations?
I would say, very important.
Yeah.
To make sure that you understand what this is, right? Is it debt?
Yeah.
Is it a contribution?
Is it an endowment? Is it a quasi-endowment?
What's it for?
Is it for operating expenses?
Absolutely. Very, very specific onto what these amounts are for. Because, the last thing you want is it to be recorded wrong, and then the donor, whoever it is, comes back later and, it becomes a big issue.
Yeah, I mean, we do another webinar, and it's pretty highly attended. It's what is a gift, and that presentation, what is a gift, and we'll probably be doing it for you guys here at Pays Boa,
Yeah.
is it was born out of the fact that Garth Brooks gave a donation to a hospital in Oklahoma in his mother's name, and they took the gift. And Garth Brooks said that, yeah, you guys said you were going to name the hospital after my mom, and it was like a $500,000 donation. Nothing, large enough to name a hospital, and or at least in most people's eyes. And Garth Brooks said, no, that's what we talked about, and he sued them and won. And so that's kind of why you want to be very clear and transparent and above board as much as possible.
Yeah, yeah. And I know we have schools that are in this situation where, they're running in the red, and they've got an angel donor who comes and bails them out. And there isn't a whole lot of understanding around what that means. Is it a gift? Is it a loan? Is it a quasi loan? Is it something that'll be forgiven later? So I think your point about having some documentation around the purpose and intent, and then ultimately, what is it? Is it a gift, or is it not a gift? So
yeah, absolutely.
Thank you.
Great.
Okay. Polling question number 3.
So which new accounting standard will be most difficult for your school to implement? Is it the financial reporting, revenue recognition, grants and contributions, or leases? So go ahead and let us know. And then just as a reminder, I wanted to make sure everyone knew that you're going to receive an email within the next 48 hours with a link that will give you a recording to this presentation, and you'll be able to download today's slides.
And we'll talk a little bit more about these high level, these specifics on the standard, but we were just gauging the audience to see what thoughts were on to what's going to be most difficult for your school to implement.
And we're at about 70%. We'll give a couple more moments for everybody to fill in. This is question 3 of 4. We're almost at 90%. Looking for one more click. And good.
Awesome.
All right. What do you think, Matt?
I mean, it makes sense. Financial reporting impacts every school,
Right
where
now.
some of these right now, where some of these others aren't going to be as big. So, that makes sense. And then leases being second, we'll talk some more about that. Makes a lot of sense as well, because all schools have leases, just about,
that's right.
So it's something we'll have to consider.
Yeah,
So.
and I will say that we had a webinar recently on some of the changes in grants and contributions. We had 300 people on there, and in 45 minutes we had 30 questions. So there's going to be a lot of uncertainty there. It's just I think we have more time for that one than the other ones.
Sure.
All right, net assets. Again, after contributions receivable, net assets and investments, those are probably the 3 biggest areas, and revenue recognition. Those are the biggest areas of highest risk in an audit. So Matt, what are we looking for here?
Net assets, we want to make sure that the school's accounting for donor funds the way they were intended to, right?
Or they were solicited to.
Or solicited, exactly. So the biggest thing here is, and you'll be surprised how many schools I come into that don't have, a roll forward of this activity, right? What the donor fund is for, what the new additions are, what the releases or expenditures are to get to your ending balance. Very important from an audit perspective so that we can understand, what are the ins and outs in these various items so that we can test that, again, that they're recorded with the way the donors intended or were solicited to do. So it's very important to have all that together. The other thing I just wanted to mention here is in line with the new reporting standard is, what you are used to as temporarily restricted and permanently restricted net assets. Some of that verbiage goes away with this new standard that's effective now. And so now you're going to have with donor restrictions or without donor restrictions, right? So your previously temp and perm are rolling into with donor restrictions on your financial statements. Doesn't change much from how you're accounting for it. You still need to know what's temporary restricted in nature, right? What's restricted for
you're
time
still going to have
purpose,
to roll that forward.
and what's endowment to be, held in perpetuity. So you still need to know that. The accounting won't change, but it's just important to understand that just some of that nomenclature changes and these amounts roll up on your financial statements going forward.
And then, another best practice here is just have a gift acceptance policy, right? I don't think anybody wants to track a gift from a family that says, hey, we want to start a $10,000 endowment, and then have to track all of the earnings and the appropriations out of that kind of gift. You need to have a policy that maybe anything under $25,000 or anything under $50,000 goes to the general endowment, and anything greater than that can be an endowment that sits on its own. Something of that nature, so that as you track these net assets, you're not creating an administrative burden that isn't worth the gift that you've received.
Yeah, and important to run that gift acceptance policy by your auditors. Make sure that
And legal as well.
And legal as well. I was just reviewing one for a school client, and I mean, it covered most of the points, but just some of the accounting and verbiage was wrong, right? It talked about any gift that they received, over a certain amount that's not restricted by the donor, they were going to put into a permanently restricted endowment fund. Well, management can't put a gift in a permanently restricted endowment fund, right? That's a donor restriction. Management can designate an amount to function as endowment, which is great to start looking at that, long-term sustainability. But just important to make sure that we have all the verbiage and the way we're going to record it correct, so that it doesn't come up at audit time as being an issue.
Great.
So
Okay.
just so I'm clear, so the reporting is with or without restrictions, but you're still asking that, as far as best practice is concerned, to maintain the temporarily restricted and the permanently restricted schedules anyway.
Yes, you will be still required to disclose in the footnotes what those amounts are. So, it'll be, with donor restrictions because of, time and purpose restrictions versus with, held with restrictions in perpetuity, which was, more so your endowment. So you're going to still have to disclose both of them. It's really just the language, the verbiage or the words being used change. So still need to track them, I don't think it changes what you're already doing.
I think that's a good point, though, because for anyone who thought, hey, I don't have to do as much work, they were wrong.
Definitely see that question. Like, okay,
Yeah.
we don't need to track them separately anymore.
Yeah, my roll forwards, I could bury them.
Yep.
Not the case.
Yep. Well, thanks.
Sure.
Thanks for that factoid.
Very good. Tuition revenue, not too much going on here. We just want to make sure that, you're putting things in the right buckets. We'll see the other side of this in the expenses in a second. Contribution revenue, we talked a lot about this earlier. I guess the thing here is, make sure you know about your conditions on gifts versus restrictions. That's always a big deal.
So we talked about most of this conditional, restricted previously. Just another best practice, making sure we have a detailed list of contributions on an accrual basis, because we're going to need that for audit. A lot of times I come in, here's our contribution listing. It's cash basis, right? So it has pledge payments that were made during the year, which is fine to maintain it on that way, but just to make sure that we're reconciling to accrual basis, so that the auditors can see a detailed trail of how we get from a detailed schedule into what's recorded on the GL.
That's a very good point, Matt. And then you will see there verbal contributions, verbal gifts, verbal pledges can be recorded if they have a history and a trail, and there's all these factors around that. That's something that you want to look at. It's definitely, we understand everybody wants to be conservative. That's the role of the CFO. And then we know that the development director, they want to record everything. I get that. But you just want to have that conversation and be in the know with regards to any verbal gifts.
Yeah, I think it's just important to just not default to a policy that, if it's a verbal gift, we're not recording it. Well, verbal gift, there may be some question as to if a valid promise to give was actually made, okay, which is fine, and then you might not record in that situation, but I don't think we should just default there, because GAAP would allow you to record verbal contributions, if a valid promise to give was made.
Right. Okay, expenses. We know that this year we're going to have to do functional and natural classification of expenses. We're going to have to disclose all that.
So the big change here is previously you just had, I've seen it in different ways, and I think the last polling question kind of sees where you guys are at with this, but you only had to disclose your expenses by functional class, right? What goes to the program versus what's your supporting services, your administrative and fundraising costs. Well, the new ASU requires that you will now have to show both functional and natural class. And what I mean by natural class is, salaries and benefits, occupancy costs, interest expense, et cetera. Show those both in the same spot in the financial statements. right? So that's a new change. It doesn't tell you where it has to be. It can be a separate schedule, a statement of functional expenses. It can be a footnote. If you're already doing a 990, you're already doing this anyway, right? You're doing this as part of the 990 process, so you can use that same schedule that you've been doing and use it to help structure what your new footnote or new statement in the financials might look like. So it's a good starting point. You may just have to start doing that schedule earlier now. I've had a number of school clients say, okay, we can do that. I mean, we're already doing that anyway, but I usually don't do my expense schedule for functional expense for 990 until after the audit's done. Well, now you're going to need it as part of the audit. So it may be that you start to do that schedule earlier on in the process than you're used to.
That's exactly right. And I just want to say with regards to functional expenses is just use methods of allocation that are consistent in the industry, right? Your biggest allocation, some of your biggest allocation items might be your depreciation expense, your interest expense, and I would suggest you to allocate that. We read a lot of private school financial statements, and we see those line items are not allocated. And when you do that, you're making the reader have to make that choice for you. Okay, well, maybe that's all an admin cost. Well, that's not going to show you in the best possible light compared to other private schools in the industry that are using all, industry approved allocation methods. So make sure you're doing that. The other thing is tuition remission. We see lots of schools make the error of putting that as financial aid. That's really a benefit to your employees and needs to be recorded in that area. Okay, polling question number 4.
Perfect. So now we're going to go through our last polling question. So how does your school currently present its expenses in the financial statements? So is it by natural class? Is it by functional class? Is it by both functional and natural on separate statements? Or by both functional and natural in the footnote?
So as mentioned previously, this kind of gauge where you are now. Like I said, you're both going forward, you're going to have to present both functional and natural class, either in a separate statement or a footnote. So we'll just see how many are already doing that, because then it's easy for you. But if you're just presenting by natural or functional class, then you have a little bit of work to do here.
And give a couple more clicks on our last question as we wrap up today's webinar. Waiting for just a couple more. This is our last question. Make sure you get your answers in.
Go ahead.
So was that just about 75% are doing either natural or functional class? That makes sense, but that means you have some work to do to put this new statement into place. Only about 25%. Those 25% that are already doing it, you're set going forward, but the other 75% will have to, again,
work on an allocation methodology. Yeah, absolutely. The biggest thing there is let's make sure it's supportable. If anybody were to come to you and say, wow, do you really have this going on? Or is that really the story that your school's telling? Make sure you have an answer to support it. Okay, leases really quickly. Matt?
Yeah, I know we're running just a few minutes left. Important thing here is just making sure you have a schedule of all the leases that the school has. What's going to be really important, and we touched on it earlier, is that there's a new lease standard coming up, and it'll be 2 years, where all leases will end up on the balance sheet, whether they're capital or operating in nature. Whereas currently you only have capital leases on the balance sheet, operating leases are a disclosure item. Going forward, they will all be on the balance sheet. This is really important for schools that lease their facilities, right? Because that's a big number.
Especially if you got a 15, 20, 25-year,
right?
30-year lease.
If you're just leasing some copiers and that kind of stuff, it's probably not as big a deal. But if you're leasing your facility, it's something you want to start looking at as to what that calculation is going to look like. To Dean's point, if it runs out 20, 30, 40 plus years, it's going to be a little bit more of a complicated transaction to be able to record what the present value of that lease looks like.
And that's a big number on your balance sheet. Big
So,
number. Other things to be looking out for, obviously this year, can't emphasize it enough. We're going to be talking about financial reporting model changes, talking about liquidity. There will be changes this year. Get out in front of it. Do your pro forma now. Get out and tell your story to your board, head of school, finance committee, audit committee, development director. All of you should get on the same page today because that happens this June.
Yeah, definitely. And I think what Dean's pointing on is just that liquidity footnote that you're going to be have to put in your financials to talk about what the school's liquidity looks like, what financial assets you have, what uses of cash you have, and make sure everyone's on the same page with that. It's never been disclosed in your financials before, and you want to make sure it's telling the right story for your school and that your board and audit or finance committee are on the same page with that.
Exactly. And then we have a bunch of everybody's in the for-profit world's been talking about 606. Well, it's true for nonprofits as well. And we have some changes with regards to grants and contributions that we'll have some clarifications on. We'll probably do that webinar for PAYSBO as well. And then lease accounting is the next one. So mountain tidal wave, NBOA was the waves of change. There's lots of change coming in nonprofit accounting, and we'll be here for you guys every step of the way.
Well, we really appreciate you. We really appreciate you joining us and helping us through this. I know for me, it's really helpful the way you couch all this in that you make it about telling the story of your school.
Yeah, that at the end of the day, that's what it is, right? We have so many stakeholders, and it matters to so many people. Let's put our schools in the best possible light, in the best possible position to succeed.
Yeah, whether it's for a donor, whether it's for your accrediting body, whether it's for, your senior leadership, your board of trustees, it's you have to tell a consistent story, and this is a great way to do it.
Yeah. Awesome. Thank you so much, everyone.
Thanks, guys.
All righty.